Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 245th VideoCast podcast for the week ending June 27, 2024. We've got a ton to cover today. A lot of key things that are going to be changing in the markets very, very soon. Want to get you up to speed on that. We'll do family first, and then we'll move on. First off, I'm so proud of Mimi, my 12-year-old, just turned 12-year-old daughter. She swam the 2.5 km open water at Beasley Point, New Jersey this weekend. She came in 12th, but this was open to all ages. She was the only 12-year-old in the top 20, and the youngest other person in the top 20 was 14, and most of the girls were 15 and 16. So super duper proud of Mimi. That's me with Mimi by the finish line there. That is the result. So you can do 16, 16, 16, 15. There's two 14-year-olds. She literally just turned 12. So she's basically 11, 16, 50. There's even a 22-year-old that she came within tenths of a second there, and then a bunch of 15 and 16-year-olds after. So just awesome. I'm most proud of the work ethic that you have to take on to get there. And this is her finishing. After they swim the 2.5 kms, they got to run to the finish line, and they're all like basically wobbly because of the hard swimming. So super proud of that. Really exciting thing to see. Then this is the back building. I did Charles Payne on Monday. This was Mimi and Annabelle swam the club meet for Silver Spring this week against Weburn, and the team smoked them. Silver Spring smoked Weburn, so we're very excited about that. Girls did great. This is in studio with Charles right before we're about to go on. There's the camera there for those of you like the behind the scenes. Then I got to do the Clayman countdown on Tuesday. This is the green room. When you go in, you walk in here to Fox, and then there's a green room, two sides there for those who like to see that. That's Charles Payne's green room, also Gutfeld's green room. That's Clayman's. Then we had a great dinner on Tuesday night with some of the other talking heads from Fox, Kevin Mann, Adam Johnson, Mark Tepper, Greg Finarello, of course, the party with Kenny Polcari and John Lonsky. We missed Lou Bassanese. He had to attend to some family things. He'll be back next time. Obviously, Mike Lee. Where are you, Mike? You got to get up here, buddy. And others, Mitch Rochelle. So they'll all be up next time. Then I got to play Quaker Ridge this week, which is one of the top 50 courses in the country. It was unbelievable. For privacy reasons, I'll just go by nicknames. My buddy Roberto, he obviously looks nothing like a Roberto, and BV. What an incredible day at Quaker Ridge. Brought my index down now in 13, which is serious progress after 2 full seasons. The goal is to get to high single digits. That's really my total of my ambitions. I'm not going for anything more than that. This is that beautiful 16th hole. Unbelievable. And then another picture with Kevin, Greg, Kenny, and Adam. And then this, I had to take a picture outside this is in the parking lot of Quaker Ridge, because this huge industrial Generac generator, which looked like a brand new device. Those of you know, we were hammering the table on Generac in the 80s, and it's now got up to 150. Now it's in the 130s, and taking a breather before the next move. And that's that. So first, want to thank Kayla Arestivo and Nick Palazzo for putting me on with the great Charles Payne on Monday. We covered Nvidia, we covered Intel, we covered the sea change that is coming in the markets, backed with data. So we're going to tune in here.
Mag 7, the Great 5, the Fab 4, right? 2024, the rally began like one of those hot rock bands, but eventually the solo star went solo. We're talking, of course, Nvidia. Now, since last October, take a look at this. This is how the market is stacked up. Since that October rally, that's Nvidia's part of it. That's the other chip company's part of it. This is the Fab 5 right here. And guess what? 484 stocks right there, right? So it has been a concentrated rally without a doubt. But along the way, we had the coronation, right? The coronation of Nvidia. I mean, think about this. How meteoric has this rise been for the stock? All right, so they're rebalancing the XLK. That's the S&P technology. You go back, this is where Apple was. Apple was 21% of this, 21%, now less than 5%. Nvidia was less than 6%, now 21%. Let's call it a changing of the guard, right? But here's what's interesting. As all of this is going on, all of that red, that's Nvidia insiders just selling every day. They're just selling. That's about $250,000 to $250 million worth of stock. Now, maybe a drop in a proverbial bucket, but still, that's a lot of red for a stock that's supposed to keep going up and up and up. So finally, here we are. We got two questions, right? Every investor wants to know, can the rest of the market rally if Nvidia begins to wobble? Well, so far, so good. This is today's session, folks. And the other question is, hey, when do we buy Nvidia back? So my next guest says there's actually more AI plays out there that you may want to take a look at. So let's bring in Great Hill Capital Chairman Thomas Hedge. So Thomas, what's your beef with Nvidia?
Well, look, it's a great company. It's a great CEO, but price is what you pay, value is what you get. Last week, I put out a note on Thursday. You know, it went up $3 more against me, 136 to 139. Now it's down 15%. This stock got up to 41 times sales. It got up to 51 times current earnings on 33% earnings growth, 70% gross margins in a cyclical commodity business.
Right.
And why is this cyclical commodity? Well, look. Intel, which you can't give away right now, has got the Gaudi 3 chip. It's 50% faster than the H100. It's half the price, 40% more energy efficient. So there are other things to do
so
right now.
Why is everyone shunning Intel? I never hear Intel in the chip conversation.
Yeah, because
I mean, they used to dominate. I mean, maybe because they squandered that lead.
They squandered the lead. They fell behind. They fell asleep at the wheel. Gelsinger's trying to turn it around. But listen to this. Think about Tesla, how the government subsidized them for 10 years. It became a multi-trillion-dollar business. The government just gave them $45 billion of grants, subsidies, loans in order to stand up the foundry business against Taiwan Semiconductor for political reasons. They are not only going to ensure that Intel succeeds, they're going to be the second largest foundry by 2030, the number one foundry in AI by 2030, and the government's standing behind them.
All right, so we're buying Intel. And right now, you're sort of avoiding these names.
Yeah, look, we're going to get some technical bounces here. 15% in 3 days is a lot. So you'll get a technical bounce. Jensen Huang did file in his 10B to sell up to $750 million of shares. He owns a lot more. He's already sold 94. As you said, the insiders have sold $750 million. So I might just get out of the way for a little while. The other key thing, last year as Nvidia went up, it got cheaper because earnings went up. Now, revenue growth quarter on quarter is decelerating from 88% down to 34% to 22% to 18%. It's only going to grow quarter on quarter revenues 7% this quarter.
AMD reports this week, I think, right? And we'll probably know a lot more. Let's talk about the broad market for a moment. Folks, these are your sectors, right? There's 11 sectors in the S&P. Consumer discretionary against the S&P, hammered. Financials against the S&P, hammered. Industrials fell off a cliff. Consumer staples, hammered. Healthcare, hammered, right? Materials hammered, real estate hammered, utilities hammered. You've only got two that have been up: consumer services, communication services, and so here I'm looking. Oh, by the way, I forgot another one: energy hammered. Yeah. I'm looking here at all of these. Look, I mean, you don't have to be a technician. They look like maybe they're oversold. It's got to be opportunity in there.
No question about it. 60% of the S&P returns were from 5 stocks. Price follows earnings. Okay, the first quarter of this year, the Magnificent Seven was 50% earnings growth. The rest of the S&P was negative 2%. Right. By the fourth quarter, it's going to be 17% earnings growth for the Magnificent Seven, 19% for everything else. Same thing with small caps. This year, only 4% earnings growth. Next year, 17% earnings growth. The market is going to start to discount this. This is a sea change. You're going to see it like the fourth quarter of last year.
I love what you said, that price follows earnings, because it feels like this year earnings have been following price. In other words, analysts after analysts said, we like this market because the fourth quarter earnings are going to be great. So the stocks have already responded. Many stocks have already responded, and now they've got to clear these hurdles. My guess is they'll lower those hurdles as we approach those earnings dates. But are any of these sectors, or a combination in these sectors, enough to provide the leadership that we've had from communication services? I mean, could we have like a lot of stocks up and the broad market is still down?
I think we're going to see a more subdued broad market indices because the heaviest weights are going to underperform. They don't have to crash. Nvidia doesn't have to crash. This is not Cisco. This is not 1999 or 2000. They're just going to dramatically underperform. And because of their weightings, the indices could be flat to up maybe single digits. But you are going to see monster rallies under the surface. So much money is going to be made in the next 6 months.
Is there one sector you like more than any other right now?
Look, I like industrial. We've got it across the gamut. But everything that's been left for dead, whether it's small caps, cyclicals, I like cyclicals. I don't think this economy, I think they're going to cut. You've got a 95% chance of one cut by December, 68% chance of 2 cuts by December. I think they're going to catch it just in time.
I hope so, because I'm afraid they're going to miss it.
Yeah, I'm seeing the slowing data too. All right,
thanks. Good stuff, my man. All right, folks.
And we're back. And then I want to thank especially here, Catherine Myers, Jake Mack, over at the Clayman Countdown for having me on with the amazing Liz Clayman. We covered a couple of names, one that you know with Disney, and then another one that we've touched on but not got into detail with Diageo. So we're going to tune in here.
Rotation. Our next guest says that the market is on the cusp of a sea change. Maybe he has a time horizon for when that will happen. He's Tom Hayes, seasoned trader, who says cyclicals will outperform in the second half. Plus, he also says the dynamic of Big Tech Mag 5 driving most of the market gains will be flipped upside down in the second half, which is 4 days away. We already starting to see that change, Tom?
No question about it. And to build on what Binky said in the first segment, we had tech earnings growth 50% in the first quarter. The rest of the 497, 493 stocks were negative 1%. That's going to flip by December. You're going to have 17% earnings growth for the Magnificent Seven, but you're going to have 19% for the other 493. This feels exactly like October 2023, right when the Fed made a position change and they said they were done tightening. Everything that was left behind, in 8 weeks, they literally rallied. You had stocks up 50, 100% below the surface. I think we're going to see that. And today, this opposite day, was FOMC member Bowman, who said, I don't see any cuts in 2024. And at the same token, we're data dependent. So she knows the data 5 months out to say there are going to be no cuts. The data is telling us unemployment is ticking up. Different inflation numbers are coming down, PPI numbers, et cetera.
So, Tom, what are the 2 areas where you would say, you know what, get a quick jump on rotating into those?
Yeah, I think in the 493, we like 2 companies in particular. Number one, don't forget the Mouse House, Disney. This is a stock that we like buying quality merchandise when it's marked down. This stock is down 50%. If you take the sum of the parts, just the parks and the experiences, like the cruises and the consumer products, it's doing $10 billion of EBIT. That alone is worth $80 a share. The stock's trading about $100. So they're effectively assigning zero value to Disney Plus, ESPN, the TV stations, et cetera. And Value Act is involved. They turned around the subscription business for Spotify, for New York Times, for Adobe, for Salesforce. Their portfolio companies, they're doing the exact same thing. You're going to see ESPN in your Disney Plus when you log on by the end of the year. They're implementing these factors. That business can do $15 billion of EBIT, which implies over the next 3 or 4 years, $180 to $200 stock.
Diageo is obviously a consumer discretionary in a way, although some would argue that liquor is a necessity.
It is a necessity. It's a staple. This got hit from 2 components. Number one, the Fed tightening cycle. As soon as the Fed started tightening, all the dividend-paying stocks got crushed, and they've still... The amount of underperformance for dividend stocks since rates went up is unbelievable, historically speaking.
What's the yield?
Yield is 3%.
Nice.
Stocks down 37%. Cash flow is growing. Earnings are growing. Revenues are growing. Their free cash flow troughed in Q2 of 2023. It's been steadily climbing back. So Johnny Walker, Crown Royal, Guinness, all the top brands, Smirnoff, the #1 vodka in the world. This is a staple. This will come back. This will recover.
Crown Royal has the best bottle.
Well, there you go.
Looks
absolutely.
like a crown.
We have a customer. Let's buy the stock.
Yeah, don't buy the Crown Royal. Buy the stock.
Exactly.
Good to see you, Tom. Thank you very much, Tom Hayes. All right, we know the teenage.
And we're back. Then I want to thank Chibuke Ogu for including me in his article on Reuters. I also want to thank today, just before we got on, Anyana Miriam Rajesh for including me in her article about Roaring Kitty and GameStop and Chewy. Obviously my favorite subjects to talk about. Not. But then this was a note out by Stifel. It says back up the truck, transportation and logistic best ideas, with GXO being at the top of the list. And it's basically outlined, by the way, there are a ton of people from Stifel who are subscribed to this podcast. It's basically our thesis: high barriers to entry, basic duopoly situation, sticky long-term customers, cycle. They're talking about the trough of the cycle, which we've covered on the last few calls, and a price target some 50% above these levels. So that was nice to see. The quote of the week, we're going to cover two, and this is especially appropriate this week. The stock market is a device for transferring money from the impatient to the patient. And this year, we've had to be patient. Look, I wake up every single morning. My goal for this year was to make my clients in aggregate $30 to $40 million of profits. We are well behind schedule on that. And if past is any prologue, like what we saw in the third week of October through the end of the year, once the Fed changed posture and said the tightening cycle was basically over, we saw all the laggards, when we had that concentration last year as well, just completely play catch up and get 2 years worth of gains in basically 8 to 10 weeks. I think we're on the cusp of that type of change. And, it's like my old mentor in my 20s, Jim Rohn, used to say, to get more, you have to become more. And there's something to be said for the temperament to know what you own and be patient when it's literally 5 stocks have driven 60% of the gains in 2024 to date. That's going to be a lot different in the second half. We own 2 of those 5 in Amazon and Alphabet, which we bought all the way down in October 2022. And then again in March in 2023, we got another bite at the apple. So we're very, very excited for the second half. We're going to lay out the case why we're so confident in that inflection, which, by the way, is not very dissimilar to the case that we made in October when all of a sudden everything flipped on the dime. And I think we're going to see that right now. In the meantime, the phone is ringing off the hook. So that's a good thing. So Warren Buffett long ago, Ben Graham taught me, price is what you pay, value is what you get, whether we're talking about stocks or stocks. I like buying quality merchandise when it is marked down. Listen, timeless truths don't change because of short-term conditions. And the reason that 95% of the people who either, hopefully not that listen to this, more likely participate in the markets is a better sample size, because I do believe a lot of you are really becoming thoughtful investors, particularly those who've been around for some time. Will never make money is because they're always going to chase the shiny objects, and they're always going to be buying at the absolute wrong point to buy, like we saw last week with Nvidia when we put out the article, The New Pain Trade, and on that day, it hit its top at 139. It actually, when we put out the article before the open, it was 136 or 137. After the market opened, it went up to 139. It collapsed 16% in 3 days. I went on Charles Payne after it was down 16%. And I said, look, it's been down 3 days in a row. We are, we're going to get a technical bounce here. And that's exactly what we got the next day, up 6%. And then today, I think it's back flat. I think Nvidia is going to be soft for a number of weeks or a couple of months. Great company, great CEO. But look, they've just dumped $750 million of shares on your head. Jensen Huang dropped $94 million on your head, all in time for the vast pool of retail buyers to come in with the split. History doesn't repeat, but it rhymes. I've seen this set up before, and that's what's taking place, as we discussed with Charles. Okay, so zooming out, which is another huge characteristic of being a successful investor versus getting whipped around by your emotions and by price. As a matter of fact, I want to read, I'm not going to say the person's name. I usually give people credit for their articles, but I think this would embarrass the person, so I don't want to do it because they've been listening for a long time, but I can see the struggle that they're going through emotionally, because nothing in their question or comment is predicated on data or any type of analysis other than price movement. And this is why Warren Buffett said and lived by and benefited from the stock market being a device for transferring money from the impatient to the patient. Or better said, in the short term, it's an emotional voting machine where most people get voted out of office, i.e. you give up your stocks to people like me at the exact wrong time, versus a weighing machine. In the long term, it's a weighing machine. So guys like me and gals like me come in, buy from you, not collective, the royal you, when you're caught up in emotions or impatience, and then we sell to you when you're caught in exuberance and enthusiasm, like Thursday with the Nvidias of the world, when people couldn't get enough, and Jensen was saying sold to you. So, okay, so what he says is, if we could get our golf scores as low as the Baba price, we could be in business on the golf course, that is. So it's a backhanded insult, which I can accept that, because at the end of the day, you know, it's funny. First boss I worked for was friends with Warren Buffett for 40 years. And he always told the story about the difference between him and Warren was in 80 to 82, the last time they had this steepest tightening cycle in the history of the Fed. That one was steeper than the one we've just experienced in the shortest amount of time. Warren Buffett was in the market, hand over fist, buying zero coupon bonds because, you know, they trade inverse. So as rates went up, zero coupons collapsed. And what they would do is basically take their equity capital. So if you could buy a 5-year zero when rates got up to 14% at, call it 60% of par or even less, 40% of par, whatever it was, and then 5 years later you were taken out whole, they would take their equity capital and let's just call it, you know, if they had 10 million bucks, they'd buy 5 million of zero coups, which automatically became 10 million in 5 years, and they take the other 5 million and put it into equities. So even if the world came to an end, they were still coming out whole. But if the world didn't come to an end, not only did they get a double on the bonds, but the equities would be up, whatever they'd be up, double, triple, quadruple. And he goes, you know what the difference between Warren and I was? Because they would talk on the phone, you know, weekly during that period. And the reason Warren became Warren and I didn't, I said, well, what's that? He goes, Warren wasn't on margin. So when we were buying at 9% and 10% and 11%, and it was going against us in a massive way, because every point in interest rates and bonds is like, you know, whatever it is, 15, 20% in terms of mark-to-market price. He goes, Warren was just slowly buying more and sleeping like a baby. I was sweating bullets and I got banged out because I was on margin. And that's the name of the game. So when people say to me, you know, worried about price or whatever, I say, listen, is the business more valuable today than it was 2 years ago when it was trading at 3 times the price? More valuable or less value? i.e., is it generating more cash flow per share? Is it generating, you know, more revenue per share? Is it generating more earnings per share or less? You know, it's just like the Jersey Mike Subways that I bring up every single week. You know, if you were going to buy it and, you know, and they basically, let's say cash flow was flat and, you know, 3 years ago, it was trading for $1 million, you know, to 200,000 of EBITDA, and it was trading for $1 million. You could buy the franchise or whatever. And then 3 years later, it's doing the same revenue and EBITDA, but you could get it for 500,000. Would you think twice about buying the franchise? And the answer is no, you wouldn't give it a second thought because there's no mark to market. And you could say, okay, that's fine. But the opportunity and the problem in the opportunity of public markets is that most people don't think about it in the way that Warren Buffett and Charlie Munger taught me how to think about it. And I'm saying taught me because I'm a student of their work. And there's no one that's been better and no one that's been more durable. There are some people that have shot the lights out with quant formulas. 99% of them blow up. One guy lived, Ren Mac, but he doesn't write annual letters trying to help the world like Buffett and Munger did. So he's really not useful to society, which is why, when he died, there was maybe 1 minute in the headlines about him. Big accomplishment, helped no one other than, 20 people. Buffett, on the other hand, and Munger helped millions of people around the world and changed the lives of millions of people and delivered enormous amounts of value with their generosity. And I say it often, I would not have a career if it was not for the generosity of thought process from Warren Buffett and Charlie Munger. But getting back to this question, so he says, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And he goes, my question is, with that valuable mindset, in the short term, the market's a voting machine. In the long term, at what point do we accept the unfavorable long-term price as the true weighted price? If was able to remove emotion and look at the chart, it becomes clear that BABA at 320 was a short-term voting price and the sub 80 is the long-term weighing price. And this is indicative of someone who has done zero research and zero homework and is buying on the basis of chart patterns or price patterns or I don't even know what. But what I can tell you is the free cash flow yield. Look, in my world, I think about publicly traded stocks the same way that I think about privately traded businesses, privately traded asset, and that is free cash flow is the name of the game. Everything else is bullshit. Okay? It's noise, it's fantasy, it's because the only reason you get involved in any investment is so that at the end of a reasonable amount of period, 3 years, 5 years, you have significantly more cash than when you got in. And then the question is, in the public markets, what multiple do you pay for that opportunity? And if, like Nvidia, you pay 51 times sales, like it traded up to right before we put that article out on Thursday, before the stock pretty much collapsed in 3 days, then you set yourself up for big risks. If you pay 8 times cash flow or 5 times cash flow or 10 times cash flow and the cash flow is recovering and growing, that's when you can make massive multiples of money. So as it relates to a bottoming process taking a year and a half, if you want outsized returns, that's what a bottoming process takes. And, we can go company by company, but let's look at BABA is a perfect example of BABA, okay, which is this major bottoming process from 2014 to 2017 took 2.5 years, and then you got to double and then you got to triple. Here was a secondary bottoming process that took 2 years from 2018 to 20. So here we are, 2022 to 2024. We could have another 3, 4, 5 months. I don't think so. I'm going to tell you why. There's an enormous catalyst in the middle of July 15th to July 18th. And then the secondary catalyst in August through September when they do the dual primary listing and bring in 180 million more of buyers. But, if you want to just ignore fundamentals, which we would never, the point that I'm making is, if you do not have a basis for owning a stock on estimates of free cash flow, either current or future, that are realistic, and you're paying a reasonable multiple, you have no business owning any stock or owning any company, because sooner or later you're going to get your head ripped off, like these folks in GameStop that were chasing price and shiny objects, like these folks in Nvidia, and I'm not saying Nvidia is going to hell in a handbasket. It's definitely going to take a break. I will say you're going to see some charts that I'm going to show you showing that the amount of people that were buying the top was mind-boggling, and the amount of people that were buying call options at the top. So they've lost all their money, 100% of it, buying the exact wrong thing at the exact wrong time, because they're trying to get rich quick, and in many cases they're doing it on margin. And those are the twin killers. Like Munger said, ladies, liquor, and leverage. I'm all for ladies, but one is plenty. You get the right one and stick with it. Multiple will get you in trouble. Liquor, anything in moderation, not my big thing, but have a beer after a round. And leverage, and I'm anti-leverage. I mean, we use very, very minimal leverage, which is why we can sit through these things with absolutely no problem and sleep like a baby, because we're not checking price. We're checking underlying business value, i.e., in the last 30 days, has cash flow, has anything materially changed that cash flow is going to be impaired or diminish its ability to go up? And in the case of all of our portfolio companies, the answer is no. For the vast majority of them, they've already troughed in 2023 with the destock restock cycle. And for the ones that don't meet those criteria, in each case, their cash flow is on the mend, going up versus down. And we were able to buy at prices that implied that their cash flow was going to be negative forever when they've all inflected to positive. And that's how fortunes are created. The problem is they're not created in 3 weeks or 3 months. It usually takes 3 to 5 years to get outsized returns, and you have to accept short-term volatility. If you can't handle that, stick your money in ETFs and go to the beach, and just accept that your money is going to compound every 10 years. It'll double at 7%, and call it a day and stick to your primary work. But I'm not trying to really beat down, but I think there are enough people that have this mindset, and just know that if you always have a choice in life. You can stick to that mindset and stay poor, or you can adopt the mindset of Warren Buffett and Charlie Munger with patience and doing the work and get rich over time, and meaningfully rich. And then if you want to become wealthier, all you have to think about is, how do I create more value? Okay, so right now, I wake up every single day saying, how am I going to make my clients $30 to $40 million this year? Okay, in 5 years, I'll be saying, how am I going to make my clients $300 to $400 million this year? That's going to be my goal, to become more valuable for them, and everything else takes care of itself. And that's my best advice to all of you starting your careers at our mid-career. If you want to get more, all you have to do is deliver more value. If you want to raise, just say to yourself, how much value am I providing to the enterprise, to the business? Am I indispensable? What can I do to become indispensable? What can I do to make the enterprise more value? What can I do to make the clients of the business happier, more satisfied, more money, more value, etc.? And you'll never have to worry about asking for compensation, because you'll be in hot demand. And that's the name of the game. So that was an aside, but I think a useful one. Let's move on to Cooper Standard, because here's another one where people can get faked out of an unbelievable company at the exact wrong time because of price, which has nothing to do with value. The fact of the matter is, and honestly, I could have just replayed last week's podcast to deliver the message, is that everything, 5%, 5 stocks, 60% of the gains, anything that is cyclical, dividend paying, or has any debt on their balance sheet is trading like they're going out of business. And we even got an Ask Me Anything question last week about that. And I just pulled up their investor presentation from a few weeks ago, which we haven't covered yet because we did an extensive analysis on it a few weeks ago from the earnings call. Certainly they have the liquidity, $281 million. But what the person was asking was, oh, what about all of that debt, which we've covered many, many times, but maybe they're new or maybe they just don't like to read, is that what you have here is we have no refinancing until 2026. And at that year, which is late in the year, I believe it's late in the year, is $43 million of refinancing. They're taking more costs than that out alone. The big refinancing comes in 2027. So if you, right now, this is what the stock market, but based on price, this is what the stock is saying. The stock is saying that over the next 2 years, car volumes will not go up. Their costs will not go down. They will not be able to refinance. Capital markets will be closed for 2.5 years. And therefore, the equity is effectively worthless at $11, which is basically what the market's saying. But if you actually get data and you look at car volumes over time, people see things in the exact reverse. So what's happening right now? The consumer's a little weak, defaults are going up, blah, blah, blah. What is happening is inventories are growing at lots, which, by the way, means Q2 is going to be great. But leaving that aside, I don't really care about one quarter. That's not why we got into it. But inventories are going up at the lots and prices are coming down. So you're saying, well, prices are coming down because demand is coming down. Partially. Price is coming down because the prices are ridiculous and they could get away with it for 3 years. What I said 2 years ago, May 2022, when we got involved, is the big three are getting away with murder because of limited supply. They can charge whatever the hell they want for an Escalade or a Tahoe or a Suburban or any big truck. Sooner or later, they're either going to build affordable cars or Hyundai and Kia and Honda and Toyota are going to rip their faces off. And that's what's starting to happen as we're seeing inventories grow. But guess when else the last time it happened was in 2016 and 2017 when Cooper Standard stock price hit its peak of 146. Car prices were starting to collapse. And what happens when prices come down? You get incentives, which means you get more volume, which means you get a race for the bottom, which means we love races for the bottom because that's how GM and Ford and Stellantis kill each other against Toyota and Kia and Hyundai. And what do? We sell weapons to all the warring parties. It's the same exact thing that we're doing with Intel. Certainly Intel has this chip that's 50% faster, 50% half the cost, 40% more energy efficient. But the real game is going to be the duopoly of foundries as AMD guns for them, as Intel guns for them, as everyone guns for them. They all have to put their production through Intel. So while all of these chip companies fight for the best, fastest GPU AI chip, Intel is set to be the biggest AI foundry by 2030. So they're the toll taker. They are the gateway. Intel gets to control the narrative. The only competition will be TSMC, and all the Western governments will be pushing the Fortune 500 to push their stuff through Intel. Why? Because the U.S. financed them with $45 billion of free money and more to come, I'm sure. So there's your liquidity, there's your refinancing schedule. Or you can look at price and make up your own story if you don't want to do work around the stock. So this is what we call a tough love session because new people, you're just learning this for the first time, and this took me years to learn. So don't worry about it. Some of the people sending the questions that have been here for 2 years, this is an opportunity to self-reflect and say, am I learning and internalizing the skills that are going to make me real money over time? Or am I falling back into a get-rich trap that's guaranteed for failure 100% of the time? And for some of you, at some point you have to acknowledge you don't have the DNA for this. If you have learned it and then you continue to chase shiny objects, emotionally react based on price, not based on fundamentals, then there are so many ways to make extraordinary amounts of money. And if you are a superlative entrepreneur, you are probably a bad investor. So most people think, oh, I'm so smart, I built a business, therefore I should be a great investor. But what makes you so great as an entrepreneur and building a business or as a sales professional is massive action. That's what makes you successful. And in investing, it's the exact opposite. It's massive inaction. do the work, constantly stay on top of the research and the business and the performance and the competitive threats, but act very, very, very infrequently. And you got to see it through to get the maximum maturity. So that's that. This gives you a little overview of why things are strange and why consumer confidence is so low. If you look at the year-to-date returns, the Dow's only up 4%, and then you've got the NASDAQ and the S&P leading because of Nvidia and those 5 stocks. That will change dramatically. Why? It's not on hope or hoping that Powell says the right thing. Maybe he will, maybe he won't. It's showing up in the earnings numbers. In the first quarter, all the earnings were skewed to Magnificent 7, 50% earnings growth. The rest of the 493 was -1 or -2. And by the back half, it's going to dramatically shift to 17% earnings growth. So they'll do fine, Mag 7, but underperform. And then the rest of the 493 will be 19% earnings growth. So all the money is going to start to flow in there. Then if we actually do catch a break from the Fed, then it's going to go bananas. And this is going to flip on its head. So we're pretty excited about that. All right, now I promised you guys some 80 some odd charts, so let's get started. Initial jobless claims, this is moving up materially, which is starting to give the Fed cover in the dual mandate as it relates to it's toggled between 66 to 68% cut in September, chance of a cut in September, 68% chance of 2 cuts by December, and a 95% chance of 1 cut by December. So we are getting cuts. It's just a question of 1 or 2. There is even some major bets being placed that July is a live meeting. I'm not that optimistic, but I wouldn't be totally shocked. I mean, it's going to come down to the PCE number tomorrow and the PPI and CPI next month. If both of those come in weak, like inflation's been coming weak, look at the initial jobless claims are spiking, then we could have something good happening. Now, transportation index, this is the leading. Look at this massive divergence between the S&P 500 and the transports. We started to see a sea change with FedEx the other night, up some 15%. They cut costs. Things are coming back, which bodes well for our GXO logistics. Also, RXO did a deal with them to buy. So animal spirits are coming back after, a year plus of depressed situation in transports, which includes the Boeings of the world, which is now coming. Boeing is rising on consistent negative headlines. That's a positive thing, and that's why we own that. Okay, so here's the transportation index. This is starting to inflect. Now, crazy for Japan to intervene on yen before Friday. So yen is hitting lows against the dollar. We believe this is going to reverse abruptly. People are saying now on the basis of tomorrow's print. I don't know whether it's going to be tomorrow's print or not. But when I show you some of the inflation numbers in Japan, you're going to see that they're going to have to stay restrictive and keep tightening, which falls in line with our thesis. Here's the Bloomberg China GDP growth consensus forecast, continues to go up. It's been climbing steadily since the lows last October. So this is another thing that you can look at, underlying fundamentals. So if you think about the country of China as a stock, on the surface, the price is telling you, oh, everything's bad. Under the surface, price is telling you everything is improving and recovering, and soon that will be reflected in stock prices. Consumer board confidence is just starting to come off the mat. Expectations coming off the mat. So this is related largely to manufacturing. We have been in a manufacturing recession for 2 years since 2022. We're seeing signs of coming out of that. Here's the Zillow observed rent index for those of you worried about inflation. This is the real data. It's on a 12-month lag. As you can see, it really started rolling over aggressively last March. And here we are into April. So we should start to see that reflected in these reports, which is the last shoe to drop. Used cars fell, new cars fell. Then finally, we got auto insurance to fall, which was an obscenely high weight in the index. And the final obscenely high weight is owner's equivalent rent. And that is the leading indicator for owner's equivalent rent. So if you think this is going up, I don't know what to tell you, but it's in black and white here. Japan CPI, here's why the Bank of Japan is going to continue to be restrictive while the rest of the world is moving into, it's already in their easing cycle. CPI year on year up right around 3% and headed higher. Ex-food and energy is a little more tolerable, but straight up. Japan inflation picks up, adding to hopes for rate hikes by the BOJ. So they'll be taking liquidity out. We'll be putting liquidity in, already $35 billion a month with the taper of the taper. And then this kind of talks about the long-term days before and after the bottom of a bear market. We're about 435 days in. We were under trend. We've just now caught up to trend. And what it also points to since 1957 is there's a lot more in the trend, of which we are in that camp as well. If you look at the multiples of the S&P, which again, 5 stocks, 21 times versus non-Mag 7, you were equal weighted, you wind up with 16 times, and that's where we want to play to take advantage of the divergence, which ultimately gets resolved. These things always revert back to the mean, and right now they're in a period of dislocation. And if there was no such thing as these type of abnormal, massive dislocations, there would be no possibility for meaningful outperformance over time. These are the situations that you have to take advantage of, that you have to do on low or no margin, so you can wait it through until you get all your multi-baggers hit all at once. Typical path of consensus EPS revisions. Normally they start the year very high and then they work down meaningfully over time, as they did in 2023. This year they are actually going back up above the initial estimates, which is why a higher multiple is justified, with 12% earnings growth this year, or 11 and 14% next year, relative to the last 24 years where it was high sixes, like 6 3/4, and you had a 17 times multiple. Now we're at 12%, 2-year mean with 21 times. If you look at PEG ratios, there's room for even more multiple expansion. But I think you're going to get more earnings growth. I think you're going to see more revisions upward. So the multiple may stay the same, but earnings actually move up, which will allow the stock market to move up more modestly. Then the thing that no one's talking about, everyone was talking about money supply was collapsing, Great Depression, yada, 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 in 2022, when we were like, no, now's the time to buy stocks. Well, now money supply is going back up, ladies and gentlemen, and that is bullish for risk assets. Largest weekly inflow to tech funds. Well, see that largest weekly inflow ever? When was that? That was at the peak of Nvidia last week. All the suckers going in at the exact same time. Largest weekly inflow to growth funds, sold to you, bag holders. And look, I understand human emotion. I understand all that. I'm just trying to teach you what I've learned through experience and through studying the greats over time. And so you can learn from others' experience versus having to pay the price of tuition. But in fairness, everyone has to pay the price of tuition if you're gonna be great in anything. So I could say this to you, but unfortunately, a lot of you will have to internalize it first and get your heads chopped off by chasing shiny objects a few times before you say, oh, I should buy a publicly traded stock the same way I would buy a privately traded company. And then you'll say, wait, if ultimately that's how it pans out, public stocks are better because from time to time the prices get so irrational, and I would never be able to get those type of bargains in the private markets. They simply don't exist unless you're buying office buildings in private markets today. For those of you in real estate, I don't know if it's early or late. It's not my area of expertise, but I am seeing some of these buildings trade. If you're skilled and a multimillionaire, or billionaire, talking to a handful of my clients who are, multi-centimillionaires and billionaires and have real estate experience, and I'm sure they're probably already doing this, but like putting together a few $100 million and buying some of these buildings seems like an absolute unbelievable once in a generation opportunity right now. I'll throw in a couple mil if you do it. All right, peak excess fiscal stimulus is bond bullish. This is good. This is in line with bonds long. So what they're saying here is, and this is normal, the fourth year of the presidential cycle is peak spending. Why? Because the number one job of a politician is to get reelected, and they spend like crazy in the year they want to get reelected, and then it stops. And so what happens is when the fiscal spending stops, bonds start to go up because you get a little slower economy. People get a little bit more comfortable about the deficits and interest service. And you saw it in 2021. November 18, which has been our model for the entire commitments of traders in our bond long. If you remember last fall when everyone was bearish and we said, look, bonds are going to rally. They have, and they're going to continue to rally because we're at a similar peak, not to mention the commitments of traders positioning at such high levels of extremes that preceded what has been the short-term rally. But as I said, when we were at 480 and change, I said 375 before 5, and we're at 425. I think we're going to 375 over the next year, and that's going to support everything we've been talking about. Multiples here, you can see across sectors, the bargains versus the higher sectors. Obviously, energy, financials, real estate, utilities, those typically trade at a lower multiple, but you can see infotech trading well above, consumer discretionary, and then you can see the excess PE by sector. So the S&P is trading 1.3 turns more than it should, according to this Z-score from Bank of America, or Goldman Sachs rather, and consumer staples is trading a little rich, but then you've got all the rest of the sectors: materials, energy, utilities, healthcare, industrials, financials, comm services, real estate, all trading at a discount. Now, here's another chart. This one I believe is from Ryan Dietrich over at Carson Group. In addition to a massive sea change in S&P 500 earnings, moving from all the earnings growth in Mag 7 to all the earnings growth, or the majority of the earnings growth in the unmagnificent 493, and a rotation into those stocks into the second half, where you could see the indices flat and tons of these stocks doubling and tripling, is the fact that small caps is going to have the similar situation. So they've underperformed. Well, so is their earnings growth at 4.1% in 2024 versus the S&P at 12.7, versus next year, the earnings growth of the S&P 500 of the small caps is projected to be higher than the earnings growth of the S&P 500. Namely, you're going to see small caps earning growth go from 4.1% this year to 17.7% next year, versus the S&P at 12.7 this year and 14.2 next year. Sectors that outperform after the first cut: consumer discretionary. Now, tech is interesting because tech is outperforming before the first cut this time, so maybe it won't outperform after the first cut, as has historically been the case. And I think we could see a similar situation like that. It is an unusual situation like 82, where you had that double inversion, and the second inversion didn't lead to a recession because you'd already had the recession in the rear view mirror, which is like we already had in 2022 with 2 quarters of consecutive negative GDP growth, and in 2020 with 2 quarters of negative consecutive GDP growth or contraction. So we'll keep an eye on that. Then you see Europe's relative underperformance. This is just a proxy for ex-US. This will not remain like this indefinitely. I think that if you're in a mean reversion mindset, some of the opportunities that are going to take place in Europe, and I think you have to be selective because there are, some of it's based on the snap election nonsense and the UK election. So there's a lot of holding period stuff and Chinese cars kind of displacing the German economy. But I think if you focus on UK and some high quality picks there, which is GXO is our major exposure there, I think you're going to be pretty pleased and benefit from this aberration and dislocation, which is the only reason any chance to outperform exists in a quote unquote efficient market. Those are the areas you got to find and you got to focus on, unless you want to just be a closet indexer and mediocre like the vast majority of the pack. So in the short term, they look fine because they're hugging the benchmark, and in years like this, they are overweight Nvidia, and then they all panic out of it at the same time. But in the long term, they're no better than an ETF if they're lucky. Whereas if you're disciplined and you're willing to accept short-term volatility, and it's not fun in the short term, but in the long term, the rewards are magnificent and worth it, then these are the things that you look for. Okay, S&P Global US Manufacturing PMI turning up. Remember, manufacturing has been basically in a recession or a depression the last 2 years. That's turning up on a global basis. That also supports our rotation thesis. UK retail sales turning up, by the way, which is very interesting. They've been in a depression for 2 years. They're now breaking out to new 2-year highs. As we had anticipated. Same thing with UK manufacturing, was in contraction, a depression for 2 years. Guess what? It's in expansion, 52.5. Big deal, ladies and gentlemen. So these aren't I hopes. This is going to happen. And sooner or later, it always happens. And those of you who have been around with me long enough know that some happen overnight, it seems like, and some take longer than expected. But the framework, as long as your framework is uniform and you don't deviate, it always works out over time. And if the facts change, you adjust. But in the case of what we're talking about, the facts have continued to get better and better and better and support our thesis. So when you hold a beach ball underwater for that long, when it comes out, it shoots to the moon. And we're going to see that they're just going to start popping all at once, kind of like a popcorn machine. New cars, substantial fall ahead. This is the chart that I was referring to. And this is from Fundstrat, but he's using it to make the case for inflation. I'm using it to make the parallel to the 2 times when you can make an absolute fortune buying over-leveraged auto parts suppliers. Okay. And that was in 2000, in the early 2000s when Munger did our motivation for doing Cooper Standard, when he did Tenneco, and he turned 10 million into 80 million, and then gave that put that 80 million into Li Lu to invest in China, and turned the 80 million into $500 million. 2 chess moves, $500 million in 5 years, 10 million to $500 million. You can see here prices were coming down right into the early 2000s, 2001 when he bought it. And when the thing did a multi-bagger from 2001 to 2003, Tenneco did, they got the debt refinanced, and then it still took time. The prices were still falling, but the volume started going up with the incentives. It's the exact same scenario. Price got too high. Now it's rolling over. And guess what? We're going to get our multi-bagger. It's a matter of time. And we've got no refinancing issues until late 2026. More than 2 years from now, and that's 43 million. So 3-year window for volumes. And this is the key to volumes, is when the arms race starts and they all start shooting each other. Your margin is my opportunity. We see this across industries. This is a theme, and that's how fortunes are made. And guess when else prices were coming off of all-time highs, which is in 2017 when you had a $146 stock price. Used cars falling, same thing. Leading index, everyone's worried about leading economic indicators. Well, they've bottomed and they're starting to turn back up, not down. So U.S. services PMI. Next is, this is interesting, China building more nuclear reactors than the next 6 countries combined. This is another example of falling asleep at the wheel. They're going to become energy independent at this pace. I mean, at some point, 25 nuclear reactors. We are twiddling our thumbs with just, we're not even on this list. This is pathetic. 0. Zilch. Nada. I mean, India gets it. They're doing 7. I mean, we're a little spoiled with unlimited natural gas, but we got to catch up here. UK retail sales. This is non-store retail, which is internet-based retail like ASOS, Guess what? Went from a depression in the last three years. Now it's turning back up once again. All these things, they just take time. That's why you don't use leverage. You don't use margin or meaningful margin. And you can just sit through it like Warren Buffett buying zero coupons from 1980 to 1982 while my ex-boss was sweating bullets. Fortunately, he lived another day and became a centimillionaire, but he didn't become a decabillionaire plus or a centibillionaire like Buffett did. But anyway, look, you can only eat so many cheeseburgers in an afternoon. Like at some point, what's the difference? A great company is not a great investment if you pay too much for the stock. Look, Nvidia is a perfect example. Great company, but great investment at 41 times sales. I don't know. You tell me. Disconnecting. Okay. So this is very interesting. Last week, look at this. This was record net call volume in the Magnificent 7 plus tech. You hadn't seen call volume that high since the peak in 2022 when everyone was chasing meme stocks and ARK and all that crazy stuff. And sure enough, you got a gut punch in Nvidia. And I think you're going to see more of that underperformance moving forward. In those groups. And then the rest of the S&P 500, the 493, no one was buying call options because like I said last week, and I think last week's article is more important than this week's article, is that while the market makes new highs, most of the stock market is trading as if the market is making new lows. And that's your opportunity. So what the divergence in people's minds right now is, I'm scared to buy stocks because the indices are at new highs. And if you look under the surface, most of the stocks are actually near new lows, okay? Anything cyclical, anything with leverage. And I think that's what's going to really fake people out is you're going to have two camps. The one camp that think the market's going to the moon and it's all going to be driven by the Nvidia and 4 or 5 stocks. They're going to get hit because those 4 or 5 stocks are going to perform less well and some are going to perform poorly, but certainly less well. The remaining 493, you could actually see probably the remaining 493 go up in aggregate 30%, and maybe the indices would only still be up 3, 4, 5% because of the weightings of those 5. And that is the opportunity that I'm trying to get at in the last 2 weeks. I hope I'm communicating clearly, and I hope this helps a lot of you. Look, again, this is all opinion, not advice. I only share what I'm doing and what I'm doing for my clients. And that's, they're accredited investors. Go to hedgefundtips.com, click on terms, talk to your financial advisor. You probably have a different risk profile and you have different needs and targets and all that. So go do that. But that's how we're thinking. Now, Nvidia, this is really interesting. Insiders are dumping Nvidia at the fastest pace in years. So do you want to be a seller? Every time they've done that, you've gotten a meaningful short-term correction. This time is the most pronounced, and this is actually outdated from Sentiment Trader because now it's gone to $750 million, not $400 million, and the selling does not seem to be abating, with Jensen Huang filing to sell as much as $750 million in his 10B, which I covered on Cavuto a week or so ago, which presaged everything that you're seeing take place right now. Moving along, big bets see Powell turning July's Fed meeting into a live one. This is a pretty big deal. This is the minority position, but I wouldn't be shocked if we get enough data. I don't think it'll happen then, but I think September is almost a foregone conclusion, which implies 2 for this year, and maybe 2 and done. Global liquidity, do you want to be getting bearish when liquidity is actually just coming off the mat and turning back up? The answer is no. Liquidity is coming back. Why? Because the West is moving into an easing cycle, removing restriction, increasing liquidity. Russell 1000 growth versus value hasn't been this extreme since 2000. What happened in 2001 to 2007? The biggest move in the shortest period of time in history for not only small cap value, but also emerging markets. I think we are in rhyming mode, repeat mode, starting imminently. And oh, by the way, here's from Charlie Balelo with a chart of what actually happened the last time it got this extreme, Russell growth versus Russell value? And the answer is Russell growth had a negative 27% return from 2001 to 2007, while Russell 1K value had a plus 84% return. So 100% spread over the preceding 5 years, the following 6 years, which means some of those small cap stocks were up 3, 4, 5, 6, 7x. And we're going to see that again. Household balance sheets remain stronger than in 2019 across the distribution, poor households and rich households alike. U.S. air travelers at seasonal record high, up 7%. All this is positive. Now, here's the interesting stat from RBC Capital Markets. Small caps typically outperform after the Fed starts to ease, not before. So if July is a live meeting, I don't know. I mean, I talk to these brilliant macro people and they have it at 60%, whatever. I think September is more likely. So if it's July, great. If it's September, perfectly great. And then you can see what happens right after the cuts is when you get the dramatic outperformance for small caps. Price to earnings ratios, you can see small caps trading at 14 and change versus the S&P at 21 and change. And again, this massive divergence. This is where fortunes are made, ladies and gentlemen. And if it was easy to sit through the bottoming process of these, everyone would be centimillionaires and billionaires. And the reason that there aren't more is because they get smoked in these periods. They can't wait, or they've done it on margin, or they want to get rich overnight, and they just can't step back and say, is the thesis, are the fundamentals of the thesis getting better or worse? Forget about the price. Are the fundamentals of the thesis getting better or worse, or staying the same, or getting modestly worse, but generally intact? If they are getting better or staying the same or modestly okay, but they've already priced in a worst case scenario, then you just hold tight, because sooner or later the reversion is abrupt, it's excessive, and it's where fortunes are made. 2-week S&P return since 1928. What this is pointing to is the strongest 2 weeks of the year, of an election year, are the first 2 weeks of July. We'll see if that holds true this year, whereas the end of June is among the worst 2 weeks, which is right now. And it doesn't feel like, it doesn't seem like that because the S&P is near highs, but the S&P is near highs because of a few stocks, and the vast majority of opportunity that we're going to benefit from in the second half are trading near lows. And that's why everyone feels odd, because you should feel, let me just put this in English. You should feel your shittiest right before inflections. That's just the way it works. Because if you don't feel shitty, it means no one else is getting puked out. And the way the market gods work is you have to feel like you're going to puke before they give you the rewards. That's just the way it works. So I don't know how else to tell it to you, other than, if that is not in your composition, know thyself and go just focus on building great businesses and give some of the profits to great managers whose composition is oddly made from that fabric. As Seth Klarman always talks about, it's genetic. Like, it can't be trained. You either have it in your veins or you don't have it in your veins. And the smartest, wealthiest people hire smart people to do it for them. And, or, many of them in candor, they hire 3 or 4 and then they play them against each other and said, okay, do good, I take from the other and give to you. Do bad, I take from you and give to the other. And, that's just the way it works. We all have bosses. I've got 20 of them, or 20 plus, and I'm grateful for them. And I know the game. And that's why I wake up every morning. How am I going to make these guys 30 to 40 million bucks this year? That's all I think about all day long. And when I get tired of thinking of that, I think about how am I going to break 80 this year? And I'm burning the edges now. So down to a 13 index, by the way. The putter helped. And now I got to bring it all together. So which means I'm going to shoot 100 tomorrow. but anyway, freight demand has been rising since the end of 2023. What's this good for? Everything, but namely GXO Logistics and others, Boeing, blah, blah, blah. All right. Percent of companies with positive 12-month percentage change in forward earnings. In other words, earnings are being revised up, not down. What does this look exactly like? You get the huge rebound off the COVID lows, then you get a check back like we got in 2013 off the great financial crisis lows, like we got in 2003 off the tech wreck lows, and then you recover again. The same cycle playing out. This is why we zoom out, zoom out, zoom out. Don't worry about the last few weeks. Worry about the next few months. That's the name of the game, and more importantly, the next few years. The new IPO game is actually starting to recover. That's been a thesis behind our Citi and our Bank of America holdings. Well, look at it. It's starting to inflect new IPOs from this depression level of 46 and a quarter last year to now we're up to 77. We'll be back to 200, 250, and the money centers are going to mint money like it's going out of style. Okay, this is Seth Golden. Equal weight SPX, S&P 500 versus cap weighted. Have not seen back-to-back years of double-digit outperformance or underperformance since 2001 to 2002. Again, 2001 to 2002. Go back and listen to last week, and we've been talking about this over and over. This was the greatest amount of money made in the shortest period of time if you bought non-tech, i.e., unmagnificent 493 comparables in 2001 and small caps and emerging markets. When you had this situation, you made a fortune. The same thing was true in 2020, which was one of our best years ever during the pandemic. Was the same exact divergence, and we can see this from a mile away, and now it's even more pronounced, and the money that can be made over the next 6 months is insane. With that said, we're still closed to the $1 million accounts, by the way. We'll open in the next few weeks. So it is what it is. 5 and 10 millions, we are open for bespoke service as always. Hedge funds exposure to cyclical and defensive sectors is at an all-time low. If you've been around long enough, you know you want to take the other side of the boat of these guys every single time. And that's why we were on with Liz and with Charles talking about back half of the year, cyclicals are going to run, small caps, dividend payers, you name it. Here's transports relative to the S&P ratio chart saying the exact same story. What's happened back to 2002 to 2004, then booyah, off to the races. Same as the 2020 lows. You want to fade this? You want to sell this in the hole? Wrong business. Go build a business, stop investing. Not for you. And make a fortune, by the way, doing it, because you're probably an action machine, and investing is the last thing you want to do if you're a massive action machine. What you want to do is go build a fortune in the real world, build a business, build a company, go into sales, do that, make a few $100 million, and then lay off a few to a manager like me, who's just wired oddly for this one thing that, I can be good at, just because I have this odd wiring, which, fortunately I found my calling. All right. S&P 500 information technology sector. And by the way, I can't do what you do, and I don't even try. So there you go. All right, S&P 500. It's funny. People look at what I do. They're like, how do you do that? And I look at what they do. I'm like, how the hell do you do that? You have to manage all those people and all those buildings and all those things. And it's like easy for you. I could never do that, unbelievable. So that's the beauty of a capitalist society. Is it the talent flows where it's needed and where it's highest and best use over time. It just sorts itself out. It's a miracle, the capitalist system. S&P 500 information technology sector, free cash flow yield. I don't know what to tell you, ladies and gentlemen, but if you want to buy these 5 stocks with the lowest free cash flow yield that they've had since 2000, have at it. But I can tell you that odds are not favorable. That's all I can say. Small caps have not traded this closely with bonds in at least 20 years. When's the last time they did it? 2002 and 2003. Bonds go up, small caps go up, off to the races. All of these things point to the same thesis. I can't make the case clearer. market cap, US market cap as a percentage of world market cap, again, hasn't been this high since the early 2000s. What outperformed after that? Emerging markets in China. How you doing? Alibaba Cloud is 4 out of the top 10 large language models in the world. They're number 1, by the way, new leaderboard ranking. Their QN2 72B Instruct is better than Meta's Llama and Microsoft's Phi 3 and OpenAI's 01 AI and Cohere's thing and Abacus thing, and then Alibaba Cloud again with their Qwen, and Alibaba again with their Qwen chat, and then Microsoft, and then OpenAI. So they got 4 of the top 10, and they're leaving Meta, Microsoft. Like I can't say this enough, ladies and gentlemen. AI is the cheapest, best AI play in the world right now, and you can't give it away. That will change, but it will change 100 points from now. The question is, are you going to be buying up at 200 when we're laying off some of ours, or are you going to be buying now when no one wants it because they're worried about price rather than looking at the fact that free cash flow is recovering, sales are recovering, everything is recovering. They finally got it right. They're taking things serious, and it's starting to be reflected. All right. What is this? Percentage of S&P 500 companies with greater than 25% trailing 12-month net income growth. This is starting to recover. That's what you want to see mid-cycle off these lows. So we basically had a recession low in March 2022. They were just unwilling to label it a recession as we did publicly on this podcast, which is why we were buying like hand over fist in fall of 2022 when everyone was selling in the hole. There were literally only 2 other public figures that were out there as aggressively bullish as we were in the hole. One was Tom Lee and one was Ryan Dietrich. Those were the only 2 public figures that I know of. Maybe there were a couple others, but not really many. Most were hidden under a bunker calling for a recession. Ratio of Russell, Seth Golden was also, I think, bullish at that point. Ratio of Russell 2000 versus Russell 100, 1979 to 2024. Again, hasn't been like this since the early 2000s, back to 2001. How many times can I say this, ladies and gentlemen? Okay, Economic Surprise Index. This is really interesting. So everyone's been saying, oh, the economic surprise, leading economic indicators is so bad, we're going into a recession. No, guess what happened? The last time they got this low, remember when Powell came into power and basically threw the stock market off the cliff right before Christmas in December of 2018 because he said we're going to just put quantitative tightening on autopilot? Well, the next week he had to change his tune. That was the last time these leading economic surprise index was this low. And guess what he did the next 2 weeks? He cut. Okay? December 2019, he almost throws us off the cliff with his autopilot nonsense and his hike. And then by the next, right after that, he has to immediately cut. And everything turned around, and I think we're going to see that in coming months. If it's not July, more likely it's September. And then we get 2, and we could be done. And we don't have to go down 100 or 200. If we got to go down 100 or 200, the economy's screwed. So hopefully they'll learn something from a history book and just do 1 and done or 2 and done and call it a day. Yen weakens, reigniting intervention speculation. They're going to intervene with the yen, and it's probably going to be sooner than they think, sooner than July. And that's going to be a massive sea change that's also supportive of everything else we're talking about. China government bond yield. Okay, it's at 15-year lows. Anytime it collapses this much, it's the beginning of an equity rally because something changes. How do we know? All we have to do, look at the Hang Seng. 2009, the yields got this low. Next thing you know, boom, massive rally, up 150% in the Hang Seng. Last time it got this low, 2016. Then what do you got? 2016, boom. Pretty much 100% double in the next 2 years in the Hang Seng, which means underlyings were up 3x, 5x, etc. 2020 got low. You got a 50% rally, and now we're at the lowest ever. I think we're going to get a bigger rally than we've seen in a long time. And it started earlier this year. It just doesn't feel like it. Stocks and Fed surveys move together. The Fed surveys have been recovering. Stocks are going to follow, as we see every single time. Continuing jobless claims peaking up here. That's going to give Fed more cover. Global earnings revision ratio, they're coming off the mat. All around the world are starting to turn back up, which bodes well for ex-US. Oh, gosh, this is a long one today. I think we're going to have to push some of these Ask Me Anything questions out to next week. Bullish bets on top performing stocks like Nvidia surged to record highs. This was published on the date that I published the Nvidia's The New Pain Trade article, and that's what happened. You can see Nvidia's collapsed 16%. You had the dead cat technical bounce that I called for on Monday with Charles when we were down here, and I think we're going to work softer over the next handful of weeks and months. I don't know about any crash, but I think it's going to be lower, certainly to the low 100s and maybe lower than that. China talks up support for the IPOs. Investors are watching the speed of approval. Japan retail investors eye risky wagers on yen intervention. Nothing risky about that. They will be intervening. The question is when. Taobao and Tmall's 2014 618 campaign scores brand loyalty. Program wins 365 brands on Tmall top 100 million RMB. Gross merchandise value, 36,000 brands doubled their gross merchandise value on 618 for Alibaba, Taobao, and Tmall. VIP loyalty program new members jumped 65% year on year to reach record high. And people want to sell it at the whole because of price versus looking at what's happening in the business. Global investors turn cautious on once favorite Japanese stocks. We've been calling that. All that was a hot money trade out of China. Same with India. Money's going to go back into China. These things are going to be left with a bunch of bag holders in our view. That doesn't exclude individual multinational companies in those markets. But in aggregate, I think that the game is winding down over there. This is interesting. All right. From Zero Hedge, EVs are not the main use for high-end semiconductors. Low-end semis, which China has pre-existing expertise, are probably sufficient for AI and large language models. The very high-end GPUs that Nvidia sell are necessary, even without access to high-end semiconductors. There is evidence that China was able to approximate high-end semiconductor performance through very aggressive use of low-end semiconductors. Hence, AI has ended up boosting the demand for all semiconductors. This would explain the phenomenal performance of the Philadelphia Semiconductor Index. The embargo is creating demand across the entire semi spectrum. That helps Intel and others. Chinese e-commerce sales up 14% during 618 Shopping Set Festival. Let's sell it at 72. Sales are up 14% year on year. E-commerce firms, including Alibaba and JD, saw gross merchandise value rise during the mid-year event. Chinese banks can improve their bottom lines with AI adoption, experts say. Who's the AI provider in China? Alibaba. Goldman Sachs bullish on China shareholder returns. Taking shape in China. Goldman Sachs said its theme of shareholder starting trend was a rewarding strategy. Yeah, so that's from Goldman. People are starting to turn. China's rich spend millions on Shanghai properties, so the game is coming back on. Alibaba stock looks poised for a rally. Why China trade tensions could be a catalyst. This is from the bearish. Oh, no, I think this is from the editors at Wall Street Journal. So that's an interesting statement. For better or for worse, Chinese sentiment and by extension, Alibaba stock could be in for a shift this week. Beijing has agreed to talks with the European Union over the block's high tariffs. Okay, so they're talking about Alibaba stock being poised for a rally. That's coming from Barron's. They tend to write good stuff. We'll see. Goldman Sachs bullish on shareholder returns. We covered that. China's Li urges stronger employment support for graduates. Beijing becomes last mega China city to ease housing rules. Japanese yen reigniting intervention speculation. China sets this is the next catalyst. China sets mid-July for highly anticipated third plenum meeting to discuss deepening reform. China's top leaders will gather from July 15th through the 18th for a highly anticipated meeting known as the third plenum, according to state medium. Third plenum carries historical significance and has previously spurred transformative periods of China's economic policy. This time the meeting has happened much later than expected, blah, blah, blah. So the analyst is out. The execution of pledged policies would alone be a key to shore up confidence and growth momentum. Further comprehensive deepening reform and advanced Chinese modernization. Proposed measures to address the housing market, restructuring of the reprofiling of local government debt and weak household consumption. Quickly, one-off increases in government debt. So this is going to be a major catalyst, ladies and gentlemen. Amazon takes on Chinese rivals Temu and Shein with plans for new discount service. So they said, not in my backyard. They're going to start doing what Temu does, which is cutting out the middlemen and ordering directly from the manufacturers in China. So when you log on, you'll see this 96-cent bullshit that Temu sells, and you'll be able to buy it directly from Amazon. And instead of getting it in 5 weeks, you'll get it in 5 minutes. Disney's Inside Out 2 could be the first billion-dollar movie of 2024. So that second piece, which has zero value assigned to it, with ESPN, Disney Plus, the TV stations, and their theatrical productions, is now turning the corner. I saw the woman who swam the sea, the lady who swam the English Channel with my daughters. Unbelievable. Did really poorly in the box office. I think that's going to be a monster hit on Disney Plus, maybe a viral hit, maybe win a couple awards this year. Highly worth watching family movie. And Disney's Inside Out 2, I couldn't sit for that, but fortunately my wife took the kids, and they said it was incredible. This thing's going to have huge legs. $1 billion in the box office, that could be like a Frozen-sized franchise. They're making stuff people want to watch now. How the UK election can make or break the pound's run, I think it's going to make. Amazon market cap pushes further past $2 trillion. A Temu move may keep it rising. So basically, they're going to smoke Temu. Once Temu gets their legs cut off in the US, they're not going to be able to sell their garbage in China, and Alibaba is going to destroy them as the consumer comes back and they stay focused on the mid to higher end. Alibaba taps Chinese top generative AI startups to boost offerings on Ding Talk. Chinese stocks are in a rut. How these policy meetings could change that. This is from the most bearish Chinese writer at Barron's. Reshma Kapadia even acknowledges that the July's meeting of the Communist Politburo and the one that we just discussed on the 15th through the 18th are going to be critical policy measures where they're going to announce all of the stuff and deal with the property and off to the races. Wharton's Jeremy Siegel expect the Fed to move to a 2-cut camp with one more good CPI reading. That's a big deal. The futures market is already pricing a lot of that in. Intel's Gaudi 3 will cost half the price of Nvidia's H100. We talked about that with Charles. Odd lots why Tom Lee thinks we could see S&P 15,000 by 2030. This is the same same argument we've been making, demographically based argument we've been making since 2020 when everyone was bearish. And I said, no, this is mid-cycle. We got another 10 years to go. Here's why. Millennials, he makes the case. It seems a little aggressive, 15,000, but if you do the math, it's about 18.5% CAGR from here, which is high, certainly higher, double the long-term average. But he makes the point that we've had several of these 5-year periods, like in the, I think, 50s to early 60s, and then certainly in the late 90s. And if the Fed does that 1 to 2 mid-cycle and done, it could actually do that. Even though it's aggressive, I don't think it's impossible. And I do think an obscene amount of money is going to be made in the next 5 years, and we're positioned for it. Bostic sees one rate cut as likely this year, but says he isn't locked in. Can't make this stuff up. It's time to be bullish on Britain. We agree. Bank woes in commercial real estate could ease with rate cuts, says Moody's. So now you're going to get the big banks starting to put pressure on the Fed governors. You're going to put pressure on the committee and say, look, you're going to start having bank problems if you don't do at least 1 or 2 cuts to loosen up conditions. And they'll do it either proactively or reactively. Hopefully, unlike Xi Jinping, they will be proactive versus reactive. But most politicians around the world tend to prefer reactivity versus proactivity. Fed President Austin Goolsbee, I thought he was the most thoughtful Fed speaker, although the bar was low after hearing Bowman. Like, what a joke. Anyway, I think her outlook was contradictory. I'm sure she's a great and smart person. But Austin Goolsbee, slowing inflation would open the door to easier policy. He's making the case. He gets it. It's amazing how much I agree with him of late versus historically. Even Alarian I'm agreeing with, which is amazing. GXO, take a look at this robot. It's the fastest robot. They're using it in their warehouses now. This thing is crazy and scary at the same time. Let me lower the volume. That thing's too loud. All right, show me the robot already. Here we go. So they're ahead of the curve. This is the fastest working robot. It lifts up to 55-pound boxes. It scarily walks around the thing. These things scare the hell out of me, but I'm glad I own the stock. All right, moving along. Goolsby lays out the dovish case. You can read that at MarketWatch. Boeing said, cleared to resume wide-body jet deliveries to China. So they're starting to deliver the 787 and the 777 cargo jets while everyone's negative on Boeing. We were buying in the hole. It's starting to move up on bad news. That's good news. Here's an article in Forbes. It points out the Mizuho upgraded PayPal stock from neutral to buy. So PayPal will eventually be able to charge 70 basis points for each transaction of Fastlane, and that will add $1 to $1.5 billion to its annual $14 billion of gross profits over the next 18 months. It's unbelievable. $14 billion to $15.5 billion of gross profits, and you can't give away the stock. He also acknowledges the Apple Pay, and he says that PayPal's buttons market share losses have stabilized based on Mizuho's research of web traffic for top retailers. He takes comfort in that trend. You don't want it to become a melting ice cube in the oven. Right now, evidence suggests it's like a melting ice cube in the fridge. You can live with that, he says. In a recent research, particularly when margins are going up on everything else, this may mean the worst of share loss to Apple Pay and others is in the past and is likely already reflected in the stock. We agree. Don't forget the mouse stock market and sentiment results. Okay, we're going to get right through this. We're moving. We had a lot to cover this week, and I think we did a decent job of doing that. The name of the game is the stock is cheap. You got the summary and the claim and countdown. I just want to highlight a few things. Earnings growth for this year, 15%. Operating cash flow, $14 billion. Free cash flow, $8 billion. Highest return on capital is in the parks. They're putting $60 billion over the next 10 years. They are, Value Act is helping them with the bundling. You're going to see the ESPN in your Disney before the end of the year. They're cracking down on the password sharing, and the business is growing. So it's a turnaround story, 25% earnings growth this year. They repurchased $1 billion of stock. They're going to buy back $3 billion before the end of this year. They got the dividend started to come back. They are well ahead of schedule on their $7.5 billion cost cut target and $8 billion of free cash flow. I don't know what else more we need to know about it other than you can read through this interview he did with Mizuho. He talks about the theatrical business. He talks about the cruise ship business. He talks about the parks being at record revenues, 5 out of 6 parks. He talks about the unbelievable demand in Shanghai right now is off the charts, which I think is probably the most important as a look through for some of our other holdings. So he says, extraordinary thing to see because of its popularity. It's the #1 tourist destination in Shanghai. It has had a huge impact on brand affinity of Disney in the country, which is what my intention was when we decided to build, print the brand flag deeply in a significant way. So demand is huge in Shanghai. Also, high-speed rail serving basically that specific area of Shanghai is growing enormously. And so just people's ability to get there. And we ended up with 7 square kilometers of land. I believe we developed 4 of that. So there's opportunity at some point there as well. And we've done some nice expanding in Hong Kong. Let's see here. Other key things, parks. If you look at the films coming up, we have Moana in November, where we're starting to lean into investment in the parks for that IP. Also happened to be the #1 streamed movie in America across all streaming platforms last year, and the film came out in 2016. So this is key, ladies and gentlemen. This is something that their competitors don't have, and this is what happened in 1984. The last time they had this problem was when the Bass family took a major position in the Disney stake. You can read it in this Disney Deja Vu stock market I wrote in January. And basically, the shift was they figured out a way to repurpose their old historic content library and resell it. And they made an absolute fortune. The stock was a multi-bagger. The Bass family made billions of dollars on a couple $100 million investment. And what did they do? They figured out how to sell their library in a new content form called the VHS tape. And now they're doing the same thing again and selling all their old content and some new content in a brand new format called what? Disney Plus. And now they're going to bundle it with the #1 sports property in the world, which is going to remain the #1 sports property for at least 10 years based on the long-term sports contracts that they've signed for specific live sport events for at least the next 10 years. And they're going to get more and more cross-collateralization led by Value Act, who did it successfully to turn around the New York Times, Adobe, CRM, Salesforce, and others. As a matter of fact, the streaming business is actually going to turn profitable by Q4 of this year, which is a big deal. What else? All right, we got to wind this thing down here. They talk about parks. Moana. Shanghai. And that's that. So sentiment's basically the same. Earnings from biotech are going up. Top 30 weights, both of the equal weight and cap weighted, are up, give or take 50 to 100 basis points for this year and next year. Earnings for the overall market, same thing. Tomorrow's the big stuff on the PCE, core PCE and PCE. That's the Fed favored inflation gauges. It's expected to come in at 2.6. Soft, that's getting very close to their target. That's the one that they use for the targeting. So we'll do that. I'm going to end the podcast here. I'm going to try to do as many AMA questions as I can. And then I'll push off whatever I don't get to until next week. So with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. So we've got Richard, Tom, great content as always. I found CCL in a screen. Wondering if you think it deserves a full weight. I think this has already moved. Carnival. The thing you got to worry about with Carnival, and I'm going to try to do more abbreviated answers this week, is that, yeah, I mean, it's just starting its recovery. The issue with Carnival about how long it's going to take to get back to their highs is just the amount of debt that they raised during the downturn was pretty significant. And I think there was some massive equity dilution as well. So yeah, they're turning free cash flow positive. Revenues are hockey sticking, massive demand. Everything is right. The question is how many shares are outstanding relative to pre-pandemic? We had the same problem with Rolls-Royce, although it wasn't a problem. It was a multi-bagger in less than a year, which was unbelievable. But we got out because they had like 4 times as many shares. So expecting it to go back up to new highs without pre-pandemic performance and 4 times as many shares is fantastical. It may do it in the short term, but there's no substance to sustain it in the long term. All right, so let's take a look here. Revenues have recovered back to pre-pandemic levels. Let's just look at share count. It went from 690 million shares to 1.2 billion shares. So, on that basis, if you think that business was going to be better than it's ever been, like when it was at 66, the maximum you could get to with double the share count in the same business would be $33, and you're at 20. So there is some more upside if you think we're going to have record demand for the foreseeable future, which I think is a strong possibility. So now you just got to make sure that they don't have a ton of debt to refinance. And I think, their cash has gone down from, they raised a ton of cash because of all those shares. And they're still burning cash. It's down to 1.6 billion from 9.5 billion. If these numbers are correct, you got to double check them in the public filings. And then their debt has gone from 10 billion to 30 billion. So I don't like this because the max upside I have is like $30 to $33 if they get to best performance of all time, because they've got double the shares that they had at the last peak, and their cash and debt situation is, 3 times worse. So I think you get to $25, you ring the register and count your lucky stars. Even though the business might do better than ever, I think a lot of it's going to be priced in at that $25 to $30 level if you're lucky. Okay. Frank Brown asks about HPE. So HP breaking out to new highs here. HPE. Free cash flow looks good. Revenues are flat and starting to improve. Gross margin starting to reaccelerate. Let's look at free cash flow. Free cash flow is recovering nicely. I would rather play this through Intel on the AI PC refresh than through HPE because Intel is not priced. I think it can continue to go. I'm sure it has a low multiple and a decent dividend, but for me, I'd rather play it through Intel because my margin of safety is better. HPE, no matter how easy it is, they always seem to find a way to screw it up. But maybe not this time. But at least with Intel, when they get through this AI PC refresh, which they're going to do over 40 million this year, they still have the foundry business subsidized by the government. That's the long-term play on AI as a free option, which I like outs. I like a lot of outs. That's why I like Alibaba. People go, why don't you buy Baidu? Because it doesn't have cloud. It doesn't have the AI ETF component play of owning equity stakes in massive amounts of APA. It doesn't have the Ant Financial, largest financial services business in Asia. It doesn't have the Costco of China with Freshippo. It doesn't, outs. More for less. That's what I like. Appreciate what the best market. This is from Drew. Appreciate what are the best market insights out there from your VideoCast, AMAs, and media appearances. I'm well subscribed to higher quality companies and aware you discussed some before at the higher valuations, but grateful for your thoughts on Estee Lauder, Albemarle, StoneCo at these depressed levels and low size positions versus sticking to higher quality companies. I think Estee Lauder is probably okay at these levels. Albemarle probably okay at these levels. You're going to have big volatility with both of those. StoneCo, I get nervous with that one just because I think you're dealing with the Brazilian consumer, or is that PagSeguro? Let me see. Yeah, financial technology, mobile channels, brick and mortar merchants. StoneCo, I've looked at StoneCo a million times and I've done nothing. This one is going to be an error of omission versus commission. There's too much that I don't know that I don't know about this business that worries me. But objectively, I can see why you're interested and why I was even interested to look at it. Yeah, $500 million negative free cash flow. So I'd want to understand that. Yeah, tell me why they lost $500 million of free cash flow and why that's going to change, and then I'd start to look at it. So that's your key on StoneCo. The others I think are okay. Thanks, Drew. I appreciate all your consistent support over the years. You've been awesome. That one we covered on Baba. Look at PAYC. This is from Joahi. No debt, good recurring revenue, 70% off from an all-time high. I think we covered this one, and I couldn't get comfort as to why they had a moat that wasn't going to be destroyed by competitors. They're decelerating in free cash flow. Obviously, the stock is priced it in. Revenues are going up. Gross margins are contracting. Let's take a look at free cash flow here. Let's look at gross margins. Profitability. Yeah, I mean, yeah, look, I see what you see here. There's probably an opportunity, but I really want to know, when these Momo stocks break like this, they could break for a while. I want to know why they have a moat. Like, what did they do that's so special? And that's a qualitative analysis that you got to do. That's going to take a lot of time interviewing competitors. And like, why is their technology not replicable? Why can't competition knock them off and kill them? And if you can answer those questions, then maybe you've got something here, because the valuation looks okay, but what is unique about it that can't be replicated and destroyed? So good start, but now you got to do the work. Michael Singh. Quick question on Alibaba. What do you think the buyback? Do you think the buybacks are just there so management compensation get dissolved once exercised? Talk about buybacks might be a bad thing. No, look, Mike, I think you're right to make that question, and I've complained about that and contacted Josiah about that. They have backed off of that in the sense that before, it was kind of a wash. Their buybacks were absorbing the dilution from the ESOP equity compensation. And now the net yield between buybacks and dividends is greater than a 10-year treasury, i.e. 4 to 5% a year net to owners, inclusive of the employee stock dilution. So the way to think about it, which I think is a fair way with the amount of cash and the liquidation and the sum of the parts, is you basically have a treasury bill yielding 4 to 5%, but unlike with the downside protected with the amount of cash and the value of the underlying businesses, with a double or triple upside, and that's why we own it, and we own it in size, and we look for opportunities to own more when we can. So thank you, Michael. Stephen Harbor, spam. Okay. Zach Williams. I was wondering if you'd put new investors' money to work in Baba. Yeah, I'd put my own money to work more, and I'd put investors, new and existing, as liquidity becomes available, for sure. Just wanted to see your thoughts on if you are fine with the position or you're willing to add more since nothing significantly changed about the underlying business. Zach, you got it exactly. Not only has nothing changed, things have gotten better with the underlying business, so I would do more. But there are position limits in terms of what I'm willing to allocate as a percentage of equity. So if I'm up at the limit for a portfolio, I'm not going to just keep adding more and adding more. If it's at the limit, it's at the limit. But our basis is very, very low now based on all the stock we've been able to add over the year and a half. So, but yes, if new money came in over the transom tomorrow, one of the 8 to 12 positions would certainly be Alibaba, and it would be one of the heavier weights, if not the heaviest. But at up to a limit, because remember, the two criteria I have before I go into any position are, number one, if this position went to zero as it relates to quality and size in the context of a portfolio, will they take me out on a stretcher? And the answer must be no. So the only way you can manage that is by sizing. So if it went completely to zero, is it sized in a way that the other 9 or 8 positions would dramatically outperform and not only make up for the loss, but be able to generate over a reasonable amount of time, 36, 48 months, meaningful outperformance over the indices net of fees? And if the answer is yes, then the sizing is correct. And we don't exceed that sizing. And the second question is, if I raise the capital to buy the entire company at the price it is quoted in the market today, would the board be insulted and have me escorted off the premises? And the answer must be yes. And I can assure you, and I know for certain, that if I was to ask Joe Tsai to buy the entire company at $300 billion or even $500 billion, they would have security take me out of the building. And that's all I need to know. So I'll leave it there. Okay. Divis Lung, I've been a long time watcher of your podcast. Love your insights and opinion on Yum C, country risks in China, but I also want to ask for your opinion on other heavily discounted stocks in addition to BAVA. Yum C, I think we looked at this a few weeks ago. I think you're probably going to be okay there. It's a question of brand. Like in the US, no one really eats Pizza Hut anymore, but I guess a lot of people still eat Kentucky Fried Chicken. So, the stock price has gone down, as has the free cash flow. Let's see if there are any signs of that turning on a quarterly basis. Yeah, a little bit. Margins going up. See what their balance sheet looks like. Revenue's going up. See if they've diluted anyone. Share count, not terrible. Cash flow. Improving. Gross margins. Steady. I think you're probably okay here. I would just, dig in and listen to like 8 conference calls and see what they said they were going to do and whether they did it and what they're going to do. And if it's plausible, I think at this level, you probably have a decent margin of safety. Let me take a look at the balance sheet. Seems okay. I think you got yourself a decent one there. Dievis Lung, thanks for the question. Let's go here. Zach Tan. Hey, Zach. Fan of the show. Been watching you for close to 2 years. Understand you have exposure to REITs via cell towers such as Crown Castle, CCI, and Vornado, which you previously had. Yeah, which was a quick almost double for us. My question to you is, have you not found any residential REITs that are attractive at current levels? Would you rather play it via tools company like Stanley Black & Decker? Yeah, I don't want to be, in an 8 to 12 position portfolio, between Generac, Stanley Black & Decker, we've got more than enough retail exposure. So it's a pass for us on that front. So we almost have like a 2 full position exposure to housing, which I think is going to be a good bet over the next 2 years. Matt Del Priori. Cost, Chief Technical Officer. All right, so Matt is in PayPal. He said, they hired a new CTO from Walmart. He says, Wall Street seems to be asleep at the wheel. Do you think the recent price move is one last shakeout like Alibaba? Who the hell knows? What's the difference? I mean, literally, when it hockey sticks, it's going to hockey stick. And, it's only been basing for a year and a half. So it might take another year and then it starts to take off again. But you can't predict that. And that's why you don't own one stock. You own, if you want to underperform, you own 30. If you want a chance at outperforming, you own 15 to 20. And if you're deadly serious and you buy each security as if you're buying the whole company and you treat it like your life depends on it, because it does for each decision, this is one of 8 or 12, and some, wind up taking off overnight and some take 3 years. But on balance, if the framework is uniform, you'll get an excess IRR over a reasonable amount of time, 36 to 48 months, and everyone will be happy. So the answer to your question is we love it. We would put new money to work. We've got a great size position in it, and nothing's changed other than the fact that the business is re-accelerating. Tim Draxel, enjoying the stock market show with your commentary along the way. Found I listened to a company, Alphan NV. Newcomer to the stock market, 50%. Adjusted guidance down. Still profitable. Revenue's a lot higher. All right, let's take a look. Welcome, Tim. Tim is new to the stock market, so thank you for the question and your support. Let's take a look at Alphen, ALFEN. By the way, a stock that falls 50% in a day is not going back up anytime soon, so you got time to research this, my friend. Let's just see here. So revenues are growing. The margins are contracting. The free cash flow is negative. It's trying to recover. The debt has increased. And what do? Design, engineering, development, smart grids, energy storage systems, electric vehicle charging equipment. I don't want to touch this stuff. I literally don't want to touch anything about electric vehicle fast charging hubs, because you're not going to pick the winner. The government's going to pick the winner, and you don't know which one it's going to be. So for me, it would be a hard pass. I think, and by the way, Tim, I like your thinking. There are some things that are just don't touch. And if it quadrupled tomorrow, I wouldn't be like, oh, I missed it. I'd be like, because I know if I take 500 of those bets, I'm losing 499 out of 500 times. So hard pass for me. But the framework is right. It's just this one is an idiosyncratic issue. ER's Thornton, digging through the carnage in the solar sector. Except First Solar, everything down 80%. Best one I could find is Shoals Technologies. Care to have a quick look? Have you found something in the space? I mean, I kind of have something. I have a free call option on that battery storage and solar through Generac. They have the green division or whatever they call it, and they're rolling up these dead businesses. But yeah, Shoals came across my radar. I mean, I think if you put a gun to my head and I had to put some money to work, that would be one of the names that I'd be taking a close look. But again, I got to understand the technology. Let me just take a look at the balance sheet because it's trading like it's going out of business right now, which most of them are. $15 million of cash, $168 million of debt, probably is going out of business. So for me, it does have positive free cash flow though. I would try to find the one that has the healthiest balance sheet that can live another day. Shoals is not secure enough for me unless I can get comfort around their refinancing plan, or they're going to issue stock, which is probably why the stock's trading down. Have they been diluting the shareholders? Let's see. Yeah, they've almost doubled the share count. So these type of people probably, they could wind up issuing a ton of shares on your head, which is what the stock is trying to tell you. In the meantime, sales have come down a little bit, but largely going up. Just dig in on this one. If you can get comfort with the balance sheet, you might have something ERs, but the irony of this is here's the irony of the joke is that if Biden gets elected, this thing probably goes bankrupt. If Trump gets elected, this thing probably is a huge success. And it should be the opposite, right? Under Trump, energy stocks did terrible because Trump said drill, drill, drill. Under Biden, they did great because he tried to restrict them. And under Trump, the green stocks did great, and and under Biden they did terrible. So it's opposite day. So if you want to own solar stocks, you should be hoping Trump gets elected, which makes no sense, which tells you everything you need to know about investing on the basis of politics. Zach Williams, you already sent that in. All right. Michael Singh, you already sent that in. Don't resend Ask Me Anything questions. I get them. All right. Pool Corp, Paul Falcone. Yeah, this one came across my radar too. This is a home builder play. I already have exposure through Generac. Revenues are decelerating. They kind of shocked the world with their negative guidance this week. I think you don't want to get in front of this bus yet, but there will come a day to take advantage of the dislocation. I just don't think it's yet. I'd want to see this a lot lower before I get involved, and I may never get it, but I don't know. Let me see. I like your framework here. I think you're early. I think you're just a hair early. I would this one's tough. This reminds me of a lot of Lululemon. There are a lot of reasons to love it and a lot of reasons to think you're early. Yeah, I just don't love this revenue deceleration. I mean, I know they had that peak COVID thing and they have more installs, so it will eventually recover. But, the high interest rates as far as people like putting in a pool, a lot of people borrow against their equity to build a pool. And I think that's a rear view mirror thing, that there was an enormous amount of pull forward during COVID, and that's partially reflected in the price. my instinct is your numbers and framework are correct. My instinct from doing this for so long is that you're just a bit early. So I guess, at 275 or 250, let's revisit it. And we may never get that, but I think it's just early. And I think you're right, and I think it's early. QXO, Daniel K. Long-time listener, first-time writing in. Really appreciate all the good content you put. Thank you very much. Thank you to all you, by the way, all the kind words. They're really appreciated. I put in a lot of work and time into this every week. I was curious what your thoughts are on taking a larger position in Solventum. Leverage spin-off. Debt maturities occur 2029. I won't. I will not take a larger position, but I'm very happy with the position I have. And after the initial sell-off in the Spinco shares, and by the way, what a home run 3M is turning out to be. Not only did we get the free shares in Solventum, but look what's happening to the company. This is spin adjusted, but we were buying down here and waiting like a year like an idiot. Not an idiot. I mean, it just takes time. It felt like, look at all this volatility we had to sit through, and then it just ripped up from now spin adjusted $70 to now 105, 103. And I think it's going to work back to new highs just as we planned. And we get the free Solventum. Would I buy more Solventum? No. Would I buy it as a one-off? Probably. But no, we're not going to do any special work on that. Jason Greenblatt, love the podcast. Really enjoys last week's coverage on massive divergence to equal weight small cap dividend aristocrat returns S&P with major catalysts for divergence normalizing between rate cuts, which can be somewhat well timed late Q3, Q4. Want to ask your approach to positioning long call spreads as opposed to owning shares. Theoretically, if rate cuts aren't a catalyst move, wouldn't that put I imagine liquidity or option volume might be an issue. I would really appreciate your thoughts. Why owning shares is more favorable. Because you don't have to be right about timing. I would just say, 90% shares. If you want to do some options, do it with 10% of the capital. Because even if you're wrong and it takes longer, the shares will still be up 50% and absorb the losses on the options. So that's that. Thanks, Jason. Appreciate all your support. Michael, Strive Foods brought in a new CEO. Stock is SNAX. Boy, a lot of questions this week. This looks like a scumbag business. From 210 down to $1. They must have had some real lowlifes running this, to put it mildly, to give that type of dilution. I really just stay away from anything like this. You can have your trading bounces, but when you got people like that involved, it's usually trouble. Let's see. Healthy snacks, air-dried meat snack products, air-dried pet treats, Frisco, Texas. Let's see here. Financial analysis, income statement. So revenues have halved, and share count's gone up 5x. I hate managers that do this, by the way. Lowest form of life. Free cash flow is negative. Now, I mean, this is a trading vehicle. This is not a real business. This is a scummy operation that hopefully, if the brands have any value, some good managers or private equity folks that know how to run a business will take control of it. Next time I'll tell you how I really feel. Dan K, longtime listener, first time writing in. We covered that. Thank you. Please don't send in questions twice. British Tobacco, BTI. I don't really like those stocks, but it's a literal cigar butt. Looks like it's recovering here. What's the dividend yield? Let's see. BTI. Well, this is going to be in the dividend basket. So with my dividend thesis, this will start to work the second half. Yeah, you're fine. You're fine there. Good find. I just, whatever. Fine. What's the yield? It's probably like 5%. I can't even find it. I never used this one. BTI. So the yield is, 9% yield. I mean, maybe they'll cut that a little bit. Maybe they won't. But yeah, I think that one's pretty solid. Thanks, Farius. Resum. Vindi. Baidu. 12 time thing. I don't know. Vin, it doesn't have enough outs for me. Like Alibaba, I've got a lot of ways to win. That it's binary. Do they retain search dominance or does AI destroy them? I think they'll be fine. I think you're okay. It's not for me. So with that said, thanks for all the AMA extra credit listeners this week. We'll see you next week. Have a great one. Bye for now.